Hi everyone, before I start this video, make sure that you're a part of my Discord server by joining the link in the description box below. And in this video, we'll be going over A-Level Accounting 2024 October-November Paper 3-1 question number 1. This is the structured paper 3 which consists of 3 questions. Each of them will be of 30 marks and the total time limit will be 1 hour and 30 minutes. So ideally, you should be spending about 30 minutes for each question, and in this video as well, we'll be attempting to solve this question number 1 under 30 minutes. So without any further delay, let's get started. Angie and Harry have been in partnership for some years. They maintain both current and capital accounts. Their financial year end is 31st December. Their partnership agreement stated that they shared profits and losses equally. Angie had a partner's salary of 10,000 per annum and interest on capital was calculated at 10% per annum. On 1st July 2023, the partnership agreement was changed. The profit sharing ratio between Angie and Harry became 3:1. Previously, it was 1:1. Angie's salary and the rate of interest on capital were unchanged, but Harry was to receive a salary of 12,000 per annum. Previously, only Angie had received a salary of 10,000. Now we also need to pay Harry a salary of 12,000 per annum. The following information was available. We have the balances at 1st January 2023. We have the capital account, premises at cost, provision for depreciation of premises, other non-current asset at cost. The value of premises is split into 50% land, 50% buildings. Okay. So land and building. So the land part will be 50% of 90,000, which is 45,000, and building part will also be 50% of 90,000, which will again be 45,000. The buildings are being depreciated at the rate of 4% per annum using straight line method. The other non-current assets are being depreciated in equal installments over a 5-year period. Okay. All right, let's take a look at other information. We cannot be calculating the depreciation right now because there was a change in the partnership agreement, and while such changes may occur, we might also revalue some of our assets. So if there is any revaluation, then we need separate values for the first 6 months where we use the previous partnership agreement and the next 6 months where we use the new partnership agreement. So for the new partnership agreement period, we need to use the revalued amounts. Now, profit and loss data for the year ended 31st December 2023 included the following. We have our revenue, cost of sales, wages and salaries, other operating costs, excluding depreciation. So we need to calculate depreciation separately. Then partner salaries were included in the wages and salaries figure. Remember, this is incorrect because wages and salaries are to be treated as part of our expenses within the statement of profit or loss, whereas partner salaries will be included later on while we prepare our appropriation account. So the first thing we need to do is subtract the partner salaries from our wages and salaries. For the first half of the year, we operated under the previous partnership agreement, which stated that only Angie were to receive the salary of 10,000 per annum. And for this period, we're only talking about 6 months. So if 10,000 is being paid for 12 months, for 6 months, we will only pay 5,000. So we need to subtract the 5,000 here. So our correct wages and salaries will be 19,700 minus 5,000, which results in the value of 14,700. Now for the second period, this is after the new partnership agreement. So in this case, we are offering salary to Angie as well as Harry. Angie will still be continuing with the salary of 10,000 per annum. It means that for the 6 months, her salary will be 5,000. Then Harry is also receiving a salary. Harry's salary was to be 12,000 per annum. So for the 6 months, his salary will be 6,000. So the correct wages and salaries for the period from 1st July to 31st December will be 27,320 minus 5,000 minus 6,000, which results in 16,320. Okay. Now on 30 June 2023, premises were revalued to 150,000 and the useful life was reassessed. Depreciation continues to be calculated at the same rate. Okay. So let's first calculate the depreciation. Let's see if we have been given any working section. For the first question, we need to calculate the profit for the period for both the 6 months ended 30 June 2023 and the 6 months ended 31st December 2023. Okay, we do not have any working section, so we can just calculate the depreciation right here. Okay, we have 2 different periods, one from 1st January to 30 June, another from 1st July to 31st December. let's calculate the depreciation on premises. For the first half of the year, we can still be using the value for building to be 45,000, and we were told that the buildings are being depreciated at the rate of 4% per annum. Okay, so that will be 45,000 times 4%, but that will give us the depreciation for 12 months. We only require it for 6 months. So times 6 by 12. This results in the value of 900. Now for the other half of the year, we revalued the premises to be 150,000. And remember, out of premises, 50% will belong to land, 50% will belong to building. So out of this amount, 50% of it will be 75,000. 75,000 will be the value for our building. And the rate will still be the same, so that will be 75,000 times 4%. And in this case, again, we need it for 6 months, so times 6 by 12. This results in the value of 1,500. So that is the depreciation on premises for the other half. Now we also have other non-current assets, and we were told that the other non-current assets are being depreciated in equal installment over a 5-year period. The cost is 16,000, so the depreciation per year will be 16,000 divided by the useful life of 5 years, which results in 3,200. That is for 1 year, and there was no revaluation made for other non-current assets, so we can just divide it equally for the 6-month periods. So 3,200 divided by 2 will be 1,600 for the first half of the year, 1,600 for the second half of the year. That is all for the depreciation. Then goodwill on 1st July 2023 was valued at 30,000, although it was not to be retained in the books of account. This will have to be adjusted within the capital accounts. We do not need that for the first part of this question. Now let's start with the first part. So from 1st January to 30 June, we have one period. Then from 1st July to 31st December, we have our second 6-month period. And we are trying to calculate profit for the period, which is equivalent to preparing our statement of profit or loss. So we can start with the sales value. I think the revenue was given 106,600 for the first half, 119,000 for the second half. So 106,600 for the first half. Then for the second half, it was 119,000. Okay. Then, let's see. We have the cost of sales as well. So we just need to subtract the cost of sales in order to get our gross profit. Let's write it down. Okay, the cost of sales for the first half is 61,700. Then the cost of sales for the second half is 63,790. Now we need to calculate the gross profit. Okay, for the first half of the year, that will be 106,600 minus 61,700, which results in 44,900. For the second half of the year, that will be 119,000 minus 63,790, which results in 55,210. Now, after gross profit, we just need to subtract all of our overheads. So the very first overhead is depreciation, which we calculated previously. We calculated it for premises and other non-current assets. Okay, so for the first half of the year, the depreciation on premises was 900, and for the second half, it was 1,500. Let's write it down. 900 and 1,500. Then for other non-current assets, the depreciation was equal for both halves. It was 1,600. Okay. Then we were given the wages and salaries. We've already adjusted and calculated the correct amount, so we can enter the correct amount here in order to calculate our profit. So for wages and salaries for the first half, it was 14,700. For the second half, it was 16,320. So 14,700 and 16,320. That is all for the wages and salaries. Then we have other operating costs as well, so we need to include that. 22,100 for the first half, 23,200 for the second half. So other operating expenses, 22,100 for the first half, 23,200 for the second half. That is all for our cost. So now we can calculate profit for the period. Okay. For the first half of the year, that will be 44,900 minus 900 minus 1,600 minus 14,700 minus 22,100, which results in the value of 5,600. For the second half, that will be 55,210 minus 1,500 minus 1,600 minus 16,320 minus 23,200, which results in 12,590. That is all for the first part. Let's move towards the next one. We now need to prepare appropriation accounts for both the 6 months ended 30 June 2023 and the 6 months ended 31st December 2023. Okay, let's start. We have 1st January to 30 June and 1st July to 31st December. We always need to start with profit for the year, but in this case that will be profit for the period, which we just calculated in the first part. That was 5,600 and 12,590. Okay, then within our appropriation account, we make adjustment for interest on drawings, interest on capital, and salary. In this case, there is no information given regarding drawings, but we do have information regarding capital as well as salary. And remember that interest on capital is something that the partnership will pay to the partners. So it will reduce our residual profit. So less interest on capital. So Angie and Harry. For the first half of the year, it will be quite easy. We can just multiply the rate of interest on capital to the opening balance of the capital accounts given. And we only need it for 6 months, so we also need to multiply it by 6 and divide it by 12. So we have the capital accounts right here. The rate for interest on capital was given to be 10%. So for Angie, that will be 50,000 times 10% times 6 by 12. This results in the value of 2,500. For Harry, that will be 30,000 times 10% times 6 by 12, which results in the value of 1,500. Let's write it down. So 2,500 and 1,500. Now for the second half of the year, since there was change in the partnership agreement, there will be changes within our partnership capital balances as well. So we need to figure out the new capital balances. We have the working section, so we need to prepare our capital accounts here. And we can just create it roughly. So we have it for Angie and Harry, and again Harry and Angie. Okay, we need to start with the opening balance. It will always be on the credit side. So the given opening balance was 50,000 for Angie, 30,000 for Harry. Whenever there is changes to the partnership agreement, there might be some sort of revaluation. So we first need to figure out whether there was a profit or loss on revaluation. The new value for premises was 150,000. In order to see the revaluation profit or loss, we need to compare it to the net book value of the premises before the revaluation. So at the date of revaluation, we can see. In this case, premises had the cost of 90,000. Now, in order to calculate net book value, we just need to subtract our accumulated depreciation. So, accumulated depreciation at the opening date was 9,000. And for the first half of this year, we still use the previous policy. So, it means that we need to include that as part of our accumulated depreciation, because after this period only, there was made changes to the partnership agreement. So, the net book value that we require in this case will be 90,000 minus 9,000 minus 900. Which results in 80,100. So we need to compare it to the revalued amount of 150,000. We can clearly see that there has been an increase in the value, which means that there is profit on revaluation. So the profit on revaluation will just be the difference between the revalued amount and the net book value at the time of revaluation, which is 80,100. This results in the value of 69,900. Now, always remember that profit on revaluation will be split based on the old profit sharing ratio. And we were told that they shared profits and losses equally before the partnership changes. So we need to divide 69,900 equally among the partners. Okay, the profit on revaluation will always be on the credit side because it will increase the capital balance. The total profit on revaluation was 69,900 and previously the profit sharing ratio was equally, so we just need to divide it by 2. This results in the value of 34,950. Alright, now we also need to make adjustments for goodwill. Remember that goodwill will be there on both sides. The goodwill on the credit side will be based on the old ratio. The goodwill on the debit side will be based on the new ratio. Okay, and we have been given the value for goodwill as well. That was 30,000. Okay, the old profit sharing ratio was 1:1, which is equally. The new profit sharing ratio is 3:1. Alright. Okay, so goodwill based on the old ratio, we have a total of 30,000. If we divide it equally, that will be 15,000 each. So 15,000 for Angie, 50,000 for Harry. Now goodwill based on the new ratio is 3:1. So for Angie, that will be 30,000 times 3 out of 4 parts. For Harry, that will be 30,000 times 1 out of 4 parts. So the total goodwill based on the new ratio for Angie will be equal to 22,500. For Harry, that will be equal to 7,500. Okay, that is all. Now we can calculate the closing balance of our capital account after the adjustments made at the date of revaluation or the change in our profit sharing ratio. Okay, now for the total on the credit side, Angie will have the value of 50,000 plus 34,950 plus 15,000, which results in 99,950. Then the closing balance for Angie will be 99,950 minus 22,500, which results in 77,450. Now for the total for Harry on the credit side, that will be 30,000 plus 34,950 plus 15,000. That will be equal to 79,950. Then the closing balance will be 79,950 minus 7,500. Which results in 72,450. Now remember that interest on capital is at the rate of 10%. So for Angie and Harry, for the second half of the year, the interest will be 77,450 times 10% times 6 by 12, which results in the value of 3,872.5. And for Harry, that will be 72,450 times 10% times 6 by 12. Which results in the value of 3,622.5. Let's write it down. So 3,872.5, 3,622.5. Now we need to subtract the salary. Remember, Angie was getting 10,000 per annum since the beginning. So for the first 6 months, that will be 5,000. For the second 6 months, that will again be 5,000. Harry did not receive any salary based on the old partnership agreement, but based on the new partnership agreement, he was to receive 12,000 per annum. That will be 6,000 for the 6 months. Now we can calculate our residual profit or loss. Okay, for the first 6 months, that will be 5,600 minus 2,500 minus 1,500 minus 5,000, which results in the residual loss of 3,400. Then for the second 6 months, that will be 12,590 minus 3,872.5 minus 3,622.5 minus 5,000 minus 6,000, which again results in the loss of 5,905. So there is no profit, there's only loss. Now we need to show the share of residual loss. Angie and Harry. Remember, for the first half of the year, the partnership agreement was to share profits and losses equally. So we just need to divide 3,400 equally. That will result in the value of 1,700 each. So 1,700 loss for Angie, 1,700 loss for Harry, which results in the total residual loss of 3,400. Then for the second 6 months, the profit sharing ratio was 3:1. So the residual loss for Angie will be 5,905 times 3 by 4, which results in the value of 4,429. Then for Harry, that will be 5,905 times 1 by 4, which results in the residual loss of 1,476. And again, the sum of these two will result in the total residual loss for the period to be 5,905. Alright, that is all for our appropriation account. Let's move towards the next part. Now we need to calculate to 2 decimal places the profit margin of the partnership for the 6 months ended 31st December 2023. Okay, this is for the second half of the year. And we're talking about the profit margin, which means that we just need to divide the profit for the period divided by the sales for the period and multiply it by 100, since we need to show it in terms of percentage. Let's take a look at the first part of the question. The profit for the second half was 12,590 and the sales for the second half was 119,000. So these are the values that we need to use. 12,590, 119,000 times 100, which results in the value of 10.58. That's the profit margin. Now we have additional information. Harry is also a shareholder in a large company in a different industry. When he looked at the financial statements of the company, he found that it had a higher profit margin than the partnership. He also saw that it had a qualified audit report. Qualified audit report means that the financial statements does not show a true and fair view of the company. Now we need to discuss whether Harry should be comparing the profit margin of the company with that of the partnership. This is of 3 marks. So we need 1 comment on why it should be comparable, 1 comment on why it should not be, and we can also relate it to the audit report being qualified and that we are comparing the profit margin of partnership to that of a company. Okay, so the very first comment is that as the audit report is qualified, the financial statements does not show a true and fair view of the company. As the audit report is qualified, the financial statements do not show a true and fair view of the company. And again, another thing that we can see is that Harry is comparing the profit margin of the partnership to the company. That would still be considered to be valid if both of the companies as well as the partnership were to be operating in the same industry. But in this case, we have been told that Harry is a shareholder in a large company, but in a different industry. So the comparison may not be valid. Let's write it down. Because the company is in a different industry, it may not be useful to compare the results of the 2 businesses. And in this case, remember the key word is discuss. So we do not need to give a concrete decision. We can just write down another point. So another point is that if he is comparing the financial statements or reviewing the financial statements, then it may help him identify the weak areas in the partnership where improvements could be made in the future. Let's write it down. The review of the financial statements may help him to identify problematic areas in the partnership where improvements could be made. Okay, that is all for this part as well as the entire question. If you found this video useful, make sure that you like the video and leave a comment below, and make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.